Hello and welcome to Deep Dive with me, Nikunj Dalmia, the show on which we just look at one single aspect and then we take a deep dive. Now, this week our focus has really been that get the best of the best global guys to tell you which way foreign institutional investors are going. Are they likely to sell more? And if they're selling more, will the intensity of selling increase like what we saw last Friday? That's question number one. Question number two, has a disguised correction in the US market already started because S&P is back to almost the election day lows now, and Bitcoin has already started correcting. Third, what we would be examining and discussing this entire week is that how much more before India becomes attractive again, both in terms of relative and absolute valuations. But my guest on the show today is someone who I've been interacting with for over 2 decades now. He's quite media shy. It takes us a lot of convincing, sometimes for many weeks, many months. This time it has taken us a couple of years to convince Jim Walker to join us back on ET now. He's been an old India bull, and you can see him on the screen purely looking at his experience and purely looking at the smile on his face that every time I say India, Jim says, yes, I got it right. So nice to have you back. How you been, my friend?
Good to be back, Nikunj. I'm well in Scotland at the moment.
So, Jim, everyone is talking about the reboot in the world, from globalization to deglobalization. Tariffs are being imposed, retaliatory tariffs are at play. In the light of what US President is trying to do, how will the world change?
Yes, well, of course, it's changing by the day, but I mean, really the kind of key here, Nikunj, is that Trump loves to be a disruptor and he loves to be unpredictable. But the one certainty that follows unpredictability and disruption is uncertainty goes up. And unfortunately, when uncertainty goes up, then you see the kind of action in markets that we've got just now. And what you don't see so much is the action that we'll get in the real economies around the world, which is that investors, businesses, will stop making investment decisions. They'll start to wait and see. And of course, wait and see is the worst possible thing to happen, because it really just means that the investment plans go off the table at the moment and economies slow down. So the great disruptor will certainly disrupt one thing. He'll disrupt investment flows. And while that happens, then economic growth is going to slow.
Do you think 6 months out, once the tariffs would be at play, we would be in a predictable place, or the impact of tariff is going to stretch beyond 6 months?
Yeah, this is the $64,000 question, Nikunj. And the big problem with Trump is that we really just don't know what his position is going to be from week to week, maybe even day to day. So, you know, a 6-month view is certainly a difficult one to assess at the moment. We've got tariffs back on for Mexico and Canada overnight. There's increased tariffs for China. There's now the retaliation coming from China and from Canada. Where does that take us? Who knows? But, you know, if economies begin to slow, and particularly if the US economy begins to slow, and I think that's very, very likely, then the direction of travel is going to have to change. And that really means that he's going to have to back off some of this aggression, as it were, with his partners and within his own country. That I think will certainly take 6 months, but hopefully by mid this year, there's going to be a lot more sensible decisions being made and a lot more visibility about where we're going. You know, the underlying fundamentals remain the same though, Nikunj, and that's that Asia actually looks pretty good. India looks great. China's recovering. And the real problems lie in the advanced economies in America. So while money is flowing back into America just now, not obviously into the stock market, I think that's a bad move.
Jim, has a disguised correction in US markets already started? S&P has gone back to levels of November. Global volatility has started inching up. The so-called famous 7, they've already started correcting. So while today we are not talking about it, but can you more than see, smell a big correction in US, which is coming?
You know, there's a famous story about stock markets that they've anticipated 10 of the last 3 recessions. The big problem with stock market commentators is that they see every move, even if it's a 2, 3, 4, 5% move, as the start of a directional shift, whether it's up or whether it's down. And most times we're wrong. We've really just got to wait and see. It would take, I would say, another couple of months of markets really being weak and falling, prices falling back, certainly 10 to 20% rather than the 5 or 6% that we're at just now, before we would really begin to say that we're in a recessionary period in terms of stock markets, which will be joining the recessionary period in terms of the economy. Now, one thing just to bear in mind about this is that if I'm right and we're looking at much weaker economic activity in the US going forward, the dollar is going to weaken. It always does in the run into a weakening US economy. And if that's the case, then there might be problems in US stock markets, but in actual fact, it will be very good news for Asian economies, for emerging markets generally, because it will take some of the pressure off companies who have borrowed offshore. So, you know, there's swings and roundabouts with these moves, but the baseline is really to say we don't know yet whether this is a true correction or whether it's just one of the head fakes that we've had so many times in the last 10, 15 years.
Jim, so if America falls, could it hurt rest of the world, or do you think rest of the world, and especially global financial markets this time, are unlikely to get impacted?
Yeah, you know, I think the problem with the US is actually the real economy rather than anything else. I don't think there's a tremendous strain on the US banking system, for example. So therefore, it's not at all like 2008, 2009. And that then had reverberations right around the world. Of course, many countries had followed the US in terms of the subprime boom with various property booms all around the place. When those started to reverse, they caused tremendous financial strain, not just in the US, but Europe, the UK, Iceland, and in other parts of the global economy as well. We don't see that kind of positioning at the moment. So this is really much more about the real economy and what's happening with the real economies. Of course, if real economies begin to weaken, then trade begins to weaken. That puts pressure on some countries, it puts pressure on growth in some countries. But the key here is really that it's much more about a real economy recession that we're looking at here. And that then has implications for the rest of the world. It does mean slower growth, but I don't think it's a collapsing economy, and it's not a collapsing sector that has tremendous financial sector implications. So that's the kind of good news from the bad news of the disruption and the slowdown.
Jim, so if dollar is looking weak, till what levels do you think dollar potentially could correct? Could it be a 10% plus correction for the dollar?
Yeah, I mean, that's exactly the kind of range that I would be looking at when we look at past recessions in the US and slowdowns in the US. 10 to 15% on the dollar as a correction is not at all unusual. And that's really been our forecast, unfortunately, too long, that there was going to be a slowdown in the US and there would be a significant dollar correction before that slowdown really materializes. I think, yeah, we could easily see a 10% correction and then a bit more in the US dollar over the course of the next 9 months or so.
You're known for a very infamous forecast, which is that you saw what was coming in 2008. Now, nobody likes it when you get a gloom and doom forecast right, but full marks to you that you were able to predict that economic cycle. A lot of comparisons have started that what is happening in the world, these excesses will end badly, and this could head eventually the 2008 way. Do you fear that? It may not happen next month, it may not happen next quarter, but are we headed there?
It's certainly not as apparent as it was in 2006-07 when we first made the forecast that the US economy was really headed for not just a recession, but a massive downturn on the back of the property sector excesses. There's certainly been excesses in terms of stock market gains, in terms of financial engineering, in terms of the way that I think countries have gamed the financial system and pushed asset prices higher. But none of that really translates into a major blowback into the banking system because companies are going bust. That's what we saw in 2008. I don't see that just now. I think the economies generally have been okay. The US has been okay, but it's only really been okay because of government spending. When you look at manufacturing in the US, it's been weak for the last 2 years. The housing market hasn't been overly done. There really isn't the same kind of signals that there's massive excesses in the system, either in the US or in other parts of the advanced economies. And that's really where financial sector troubles tend to begin. So no, I don't think this is like 2008. It'll be a pretty painful, I think, slowdown. That's what uncertainty produces. But at the same time, I think we can get out the other end of it without the kind of required government and central bank action that took place in 2008, 2009.
Now I've got a list of where you've been bullish on and what are you bullish on. I'm just going to again bring this out for the perspective of our viewers here so that they can relate to some of your long-term forecast and how you've really been pinpointing some big trends and how they have now, you've really got them accurately correct. In 2022, Jim was recommending to his subscribers and clients long blockchain, which is Bitcoin. Then December 2022, long Sensex. Look at the return from there. There was a short recommendation in 2024, short SET, and that also has done reasonably well. But currently, he's bullish on gold. He's bullish on copper. Now, Jim, copper does well when the world does well, which is, it is a representation of industrial economy. Gold does well when there is uncertainty in the world. So they both, in a sense, are not joint at the hip. They are they have the converse correlations. But you're bullish at copper, which is a hedge, gold, which is a hedge, and copper, which is a bet on growth.
Yeah, it's quite interesting. We brought both of those longs into the global strategy at the same time, but we tried to explain that this wasn't the usual kind of gold, copper, lockstep, if you like, the commodities are moving. It was very much a case that we were trying to say that people should be long gold as a hedge against what central banks have been doing, and in particular against what advanced economy governments have been doing over the course of the last decade, and that's really spending money that they don't have. So fiscal deficits have blown out of all proportion to where the economy is supposedly in the economic cycle. Government debt levels have gone up dramatically to over 100% of GDP. You know, India keeps worrying about its debt position. The forecast for the central government debt in India by 2030 that it will be around about 50% of GDP. Every advanced economy that we look at would be desperate to get to that kind of level. I mean, India is a paragon of virtue in comparison to these countries. So what we were trying to say with the gold long was that, you know, bad behavior has its consequences, and people start to lose faith, especially in the currencies that central banks and governments are printing, paper money. So it was time to be much, much more aligned with the old-fashioned currency, the one that doesn't get printed out of existence, and that's gold. The copper call was actually, and we tried to say to clients at the time that, this is a 10-year call. It's not a 1 to 2 year call. Gold could easily have been a 1 to 2 year call. The copper call was about the green transition, the carbon neutrality, the renewable energies, electric vehicles, because all of that is incredibly copper intensive. And the truth of the matter is, Nikunj, the supply of copper is constrained. It takes a long time to sink copper mines and to actually find some of the copper mines, and then to bring the production on stream. The rate at which governments and the world is moving towards this transition is too much for the copper industry to handle. So what we were really saying there is that demand will outstrip supply dramatically over the course of the next 10 years. Therefore, it's very sensible to be long copper.
Jim, you are bullish on India and you think China will be stable. So if our viewers have to really choose, should they lean towards India more or should they move out of India to China? Because you've given perhaps equal weightage to both is what I understand. Yeah,
this is a difficult one, Nikunj, because my own preference when I look at the state of policy generally, so monetary policy, fiscal policy, and exchange rate policy, India looks to, I said this in a report that went out yesterday to our clients, that India looks better to me now than at any time in the last 30 years in terms of policy stability and policy certainty. I think the authorities have done a remarkable job in actually stabilising the whole macroeconomic structure in India and framework in India. And that's a very positive backdrop for me. The thing that they need to address now, and I think it's very, very clear that the government understands this, and it's going for it over the next 1 to 2 years, and that's deregulation, ease of doing business, cutting red tape, and allowing the small and medium-sized companies in India much freer rein to grow the economy and grow their labour forces. That's the next phase in India, but that's nothing to do with macro policy. That's everything to do with micro policy. So, I've said to clients this week that this is the time to absolutely double down on the long on India, go much, much longer. And although worry about the valuations in the Indian stock market, my view is that economic growth is going to take off from here. And those valuations will be very quickly supported by corporate earnings.
I like that. I like that. When you say double down on India, say it again. Jim Walker, double down on India. Come on, say it again. I want to hear you loudly.
But yes, at the moment it's a difficult call to make because people are nervous. But I just think that the whole backdrop in India and the absolute realisation at government levels that this is the next phase of the India story, cutting red tape, deregulation, improving ease of doing business and getting the economy moving into a 7, 8, 9, 10% GDP growth rate over the next 5 years. China is slightly different. China has been through the mill over the course of the last 3 or 4 years. It clearly had a policy of trying to reduce the size of the property sector in the Chinese economy. That was absolutely essential. They had basically the same problem as the Americans did in 2007, 2008. Not quite subprime, but just a property sector that was far too bloated. And over the last 3 years, whether you like it or not, and a lot of people in China didn't like it, especially rich people, the government focused on property and reduced the size, deflated the bubble. And of course, that dragged on economic growth. Now, September last year, when the central bank, the Securities Commission, and one of the agencies, the other agencies involved in securities supervision, sat down and said, we're increasing the flow of funds to the banking sector to support some property projects. We've got various other things in mind to support the property sector and to ensure that properties that have already been paid for are delivered to homeowners. That was a clear signal to me saying, job done. We no longer need to bear down on the property sector. We're not going to make it a boom sector anymore. We're just going to support it and allow the economy to start recovering. Now, I think that's already happening in China. We're starting to see, I think, some of the numbers that would support that view. Their inflation rate is low, interest rates are low. There's no problem with finance in China. And it's really just a question of resuming confidence there. And I think with the property sector stabilising, that confidence will come back. So I don't think that the Chinese economy is going to be dramatically different this year from last year in terms of economic growth, maybe about 5.5%. By 2026, I think you'd probably be looking at much more like 6.5%, 7% growth in China. So a significant upturn in the Chinese economy. The one thing that China doesn't have at the moment, that India very clearly has, is good corporate earnings and a good profit cycle in place to support an increased investment cycle. That's where India scores very heavily. That's why I prefer India in my own investments and the recommendations to China, although I think people should be increasing their China positions as well, partly because there's so many people very underweight there.
Last question, and I'll phrase my question in two parts. I'll keep the time horizon separate, which is 3 years, but I will change the profile, which is that if someone is looking at a low risk, low return instrument or an asset, which is your number one bet. If somebody is looking at absolute returns, but with some underlying volatility, which is the best asset for 3 years?
Low risk, low return. Yes, that's a good question. If we were looking at government bonds, then, believe it or not, I'm going to say India again, because again, the note that we put out yesterday is looking for 75 to 100 basis points cuts in Reserve Bank repo rate over the course of this year, with possibly more cuts to come in 2026. So there's very good upside in terms of not so much the yield on Indian government debt, although that's good at the moment, but the capital gains from a rising bond price. So for my money, that would be one of the best positions to be holding at the moment. Long-term riskier, and a 3-year view in particular. One of the other longs that we've got in our portfolio is Vietnam. And I know it's a small country and it's kind of off most people's radar screens, but the politics in Vietnam and the growth and economic dynamics there all suggest that over the course of the next 2 to 3 years, there's going to be a very strong acceleration in the domestic economy there, partly as the new General Secretary just consolidates power. And that means making sure that the economy is moving. So I would actually be long Vietnam in that respect. I think that's still one of the best bets. If you want a really kind of out there one, it would certainly be continuing to be long blockchain. It's very volatile, but I think that the end of Bitcoin is being grossly overdone at the moment. When people are looking at the price, they're again expecting what is a correction to be a collapse, and I don't think that's the case. And the underlying technology, blockchain, as I say, it's volatile, but it's definitely, in my view, going much, much higher.
Walker, always a pleasure to have you on ET Now. We've just covered a range of topics. You've been very accommodative with this interview request. You've given us almost half an hour of your valuable time, so really appreciate that. And I'm just going to summarize the interaction with Mr. Walker. He feels that the US market is entering a patch of volatile phase. dollar index could go down anywhere between 5 to 10%. What looks like a trouble right now, markets could force the US administration to go easy in terms of implementing Trump and tariff. Double down your India exposure, loves gold, and a low risk, low return asset according to him for next 3 years could be Indian government bonds and Vietnam as a market if you're looking at something new or something really exotic. Well, that's a huge mega exclusive. It was Jim Walker really walking us through what he makes of the current market dynamics.
If you like this video, then like, share and subscribe to ET Now.